How's everybody doing today? This is Professor Suarez bringing you the final exam review, exam 3. I hope you guys are excited because I am. I'm ready to get this done, go on Christmas break, get some Christmas gifts, and I'm sure you guys are too. So let's get started. So chapter 8 was about home and automobile insurance. So one thing about insurance is it is your ability to cover yourself in the event that something happens. And the chance that something may cause you loss is known as risk. And this chapter highlights 3 types of risk. So we have personal risk, property risk, and liability risk. I'm just going to run through these really quickly. Personal risk describes the loss of life or personal income or health, right? Property risk is when you are losing either your assets or some physical object that you own that may have resulted from certain perils like fire, theft, or even some hazard on the road, for example, right? And the last one is liability risk, which includes loss of any of the things that were previously described, but caused by negligence. Okay. Now, one thing I do want to highlight is the difference between peril and hazards, right? In your textbook, it describes it as an event, or it doesn't describe it like this, but I changed the definition. Peril is an event or circumstances that can cause a possible loss. An example would be like describing property risk is a fire or a hurricane or a flood. Those are perils, right? So quick question, would an example of a peril be a defective wiring? The answer is obviously false. Defective wiring is actually a hazard. A hazard is a factor that increases the likelihood of loss through peril. Okay? And then you also have negligence, which is failure to take ordinary or reasonable care in a situation. Okay? So when it comes to managing risk, the things that you could do, you could avoid risk. You could steer clear from it altogether. You can avoid risk of plane crash by not flying. Those are, that's one way to go about it, but that's not, you can't live life that way, right? So sometimes you have to, yeah, there's things you have to do. So one thing you could do is risk reduction, right? You could decrease the odds of loss or injury. Example is you could reduce the risk of your computer being hacked by installing antivirus software, right? Then there's risk assumption, undertaking the negative effect of risk. And you may choose to waive collision insurance for a car that is older because you understand that even though you might get hit, and the car is an older car, it's already beat up. Like, what's the point of paying more money for something that you don't necessarily need? And then risk shifting is transferring the risk of someone else, usually to an insurance company or through investments, right? And you might be saying, well, how does investments reduce risk? They actually reduce risk for the company, right? Because what happens is by sharing equity or sharing their value, right? If they happen to lose money, they're not going to lose as much because a portion of that loss goes towards the other people that own the company. And we'll talk about that in chapter 11, right? So insurance coverage, right? So insurance coverage is designated in 3 groups: bodily injury, property damage, and then there's collision coverage, right? Bodily injury liability is usually expressed in 3 numbers: 100, 300, and 50. So what these represents is individual coverage, maximum coverage for all 3 people, and the third aspect is what's extended to other people who may not have insurance. So 100, 350 would mean 100,000 for each individual person is covered from bodily harm, right? and it's a maximum of 300 people. So that means if you have 3 people in the car, each person is covered for 100,000. 100,000 divided by 300,000 is 3, right? And then 50,000 is just allocated for people who may not have insurance and need some type of coverage. Okay, these are important aspects to read, especially if you tend to have more than one person in your car. It's always good to have that just in case, right? And it's not to say that has anything to do with the way you drive. It's more so with protecting yourself and protecting everybody else. Okay. Property damage liability applies when you damage your property or property of others. Also extends to cars that you are driving with someone else's permission. So that's a really important piece, right? So if let's say for example you borrow your sister's car, right, and you get into an accident, your property damage liability, if you have it for your own car, extends to your sister's car as well, which is great. Collision coverage is insurance that covers you when you're in an accident. So let's say, for example, you're driving on the road and you run over a piece of metal. Interestingly enough, the insurance companies would consider that an accident that's avoidable that you caused, and it would be covered by your collision coverage. Okay? Now, before we get into Chapter 11, one key thing that happens with insurance is the amount a person gets covered, and the other aspect is the different ways that they determine the value of whatever it is that's being covered. So an important formula is or something to consider is actual cash value, right? And actual cash value used to be, or was assumed to be, the value, so the replacement value or replacement cost to replace that item minus depreciation. But it's not considered that anymore. There was a couple court cases that found that the actual cash value should be and will always be the replacement, either the replacement cost or it'll be some aspect of the actual value of a new item to get that replaced. But it will never be depreciated, or it will never be taken into, like, they won't deduct if it's old, or they won't deduct cash if for whatever reason it's an older model, because your insurance, right, when you get it, is supposed to cover that item, right, and what you paid for it, because that's what you're getting it insured for. So if they decide, oh, well, after deductible and after depreciation, you're only eligible for this much money, that impacts you, because there's things like inflation, whether the item is still available, right? So imagine if you buy a BMW, right, and you pay $20,000 for it, you have the car for 5 years, and after that, it's only worth $10,000, right? And you get $10,000, you're gonna be pretty upset. You can't buy another BMW. So that's what the insurance does. It reduces your risk of loss, so much so that it's always a valuable thing to have. Okay? So now let's talk about investing basics and evaluating bonds. Now, factors affecting the choice of investments, if you consider safety and risk, are one of the biggest factors, right? Is an investment safe? Will you retain value? Is there a chance that you could lose value? Those are the main things that come into mind with investments, right? There's always a component of risk, though. Even if you have investments that are guaranteed, right? Which in some cases you can buy investments that are backed by insurance policies or insured by your tax dollars, right? And those are products that are available. There are still components of risk, and these risks could be inflation risk if the value of the dollar goes down or up, right? But there's always a risk of that. Interest rate risk, which is if the interest rates go up, that affects certain payouts or investments. Business failure risk, if the business goes under, they can't pay for anything, right? And then finally, market risk, which is if the whole market goes through systemic risk, like if there's a bubble, that'll impact your investments, right? So investment income is what I would like to call residual income. It's income that's generated without work. It's income that can be generated from just an investment. Now, a lot of people assume that the only investments you have are stocks and bonds, right, or mutual funds. The reality is there are investments you could take. If you invest in your own education, for example, that has a tremendous effect and tremendous impact on your overall cash flow in life. If you invest in somebody else, for example, in their business, you retain equity, and they're not publicly traded. But if their business continues to progress and prosper, or you give them a loan, that money's going to come back to you with interest in most cases. All right. Investment liquidity is the ability to buy or sell an investment quickly without substantial effect on the value. So liquidity is just another word for how quickly could I get the cash back. If, for example, I buy a cell phone, right? And let's say this happens, like, I need the cash. I spent too much on my cell phone and I want to sell it. How quickly is it going to take me to sell that cell phone? I probably won't, unless it's like a new phone, like iPhone X in mint condition, I'm probably not going to sell that phone in the next week or so, right? Now, if I put my money in a bank account and I need the cash back, I just go to an ATM or go to a teller if the banks allow tellers, and I'll be able to take out the cash right away. So which one's more liquid? Obviously, the bank. Okay. Factors that reduce investment risk: asset allocation, diversification. Asset allocation is just where you put the money. So if you put it in more volatile stock, which means that it goes up and down a lot, you have a higher chance of making more money, but you also have a higher chance of losing that money. So sometimes it's better to have safer investments, money that what the trajectory is and how the money's going to move, right? And then diversification is a form of asset allocation or a form of investment where you're putting it in non-correlating stock. What does that mean? That's a complicated way of saying that you're putting your stock to go down while your other stock goes up. And you're probably thinking, why would people do that? In most cases, if you know what you're doing, the amount that the stock goes up is substantially more than the amount that the stock goes down. You get what I'm saying? So if I were to, explain it here. Let's say, for example, I have this stock that is worth $100. $100 in shares in Apple, for example, right? Apple. Okay. And it goes up 7%. Right? I made $107 in revenue. Now, if at the same time I have another stock, let me actually put it in a different color. I have a different stock, all right, and I have maybe $1 in, Aunt Jemima stock or whatever, and that goes down, negative 3%. I've only lost 3 cents. So then I end up with 97 cents. Right? This is a crude example, but if I lost 3 cents but gained $7, I'm still good. I have a profit of $6.97. Right? So why do people do this? The first reason is it reduces risk, right? So God forbid anything happens and I have something that happens to the Apple stock and I lose a lot. If I have my investments diversified, then I'm actually able to protect myself from losing more than I usually do, right? If I had just the Apple stock and I lost that 7%, that means I lost $7, right? But if I had stock that's allocated to something else that goes up 5%, and I have the same amount, I won't lose the full 7%. You get what I'm saying? So it reduces my loss, but at the same time, diversification reduces your ability to make more money. Okay? So that's an important piece. Not for the test, but it's an important piece for life. And then your age when you plan to start investing also impacts whether or not you allocate it differently, okay? Which we'll talk about a little bit later. Your role in the investment process. So with your role in the investment process, you have to evaluate the potential of investments. You have to do your research, right? You have to monitor the value of your investment, and you have to keep accurate records. As of right now, there's no class that helps you to determine what investments are good or bad, or how to speculate on the market. But once you get into financial courses, they go about it in brief detail, not too in depth. It's only when you get your Series 7 license and your license to sell and buy securities that you actually get into the process of figuring out which investments are good. Now, conservative investment options. Conservative means that you don't want to take a lot of risk, right? So these government bonds are generally risk-free, right? Treasury bills sold at discontinued prices with short maturity ranges from 4 to 52 weeks. What this means is, no, sorry, I don't mean discontinued, discounted prices. So a treasury bill is no risk because what happens is the government could just charge more taxes to cover the cost of the treasury bills, right? And the government will never go out of business because it's the government. So that's why they're considered no risk bonds, right? Now, treasury notes have a longer term and usually take about 1 to 10 years and pays interest 2 times a year. Now, because this is a longer period, they usually have higher interest rate or a higher discount rate, which is just a higher amount that they pay you back. And then treasury bonds, the longest maturity at 30 years, pays interest 2 times a year. Okay? Now, the thing with bonds is usually the par value or face value is 1,000, right? But you could buy it at some substantial amount less than 1,000. And then over that time period where they're going to pay you back, they will pay you the full value of $1,000. And that's what you would call your interest rate or your coupon rate, right? Treasury bills are safe, low risk investments, but the payout is substantially smaller than what you would get for the following other options. So corporate bonds, for example, is a corporation's written pledge to repay a specified amount of money with interest. The face value is the dollar amount, and the bondholder will receive at a maturity date. The maturity date is the date on which the corporation is to repay the borrowed money. Now, sidebar, to calculate this, the tax equivalent yield is the tax-exempt yield divided by 1.0 minus the tax rate. Now, corporate bonds are not tax exempt. Government bonds are. In government bonds, tax exemption rate will usually be given to you, and then if you needed to find out what the taxable equivalent yield is, you would use this formula, right? Now, the tax equivalent yield is simply how much money would I need to make with a corporate bond to equal the amount that I'm making with this tax exempt bond. You see what I'm saying? So for example, if I'm getting 5% return on the government bond and a 7% return on the corporate bond, you would assume, oh, well, the corporate bond's a better investment because I'm getting more money back. But you're getting taxed on the corporate bond return. So you would use this formula again to figure out which bond is a better investment. Now, another thing too is municipal bonds are exempt from federal tax, state tax, and some municipal tax, and are attractive to some consumers looking for a tax shelter. Using the taxable equivalent yield and tax-exempt yield could help determine which bond is worth investing depending on your tax bracket. Very important sidebar. So the types of corporate bonds include a debenture, which is a bond that is banked only on the reputation of the company. The mortgage bond is a bond secured by assets of the issuing firm. This is less risky because if the corporation can't pay you, right, then you have some right to some asset that you've helped them to buy, and they sell it, and then you get the cash back. Convertible bonds are bonds that could be converted to equity and shares, which is a great option if you have a good company. And then the sidebar, current yield of what you're getting is equal to annual interest amount divided by the current price. So if I'm getting $15 every coupon payment for $1,000, then the yield would be 15%. No, I'm sorry, 1.5%. So let me write that down. So if I have $15 that I'm getting in coupon payments. Sorry, very bad handwriting. Oh, Jesus. Coupon payments. And the value of the bond was $100. Let's do it that way. Then, let's see, current price. You just plug it in. 15 divided by 100 is equal to 0.15, which is also equal to 15%. Look at that. That's a horrible. Oh my God, I have such bad handwriting. Stocks versus bonds. Bonds are loans, right? And have claims to assets before stockholders. So what this means is that if the company goes bankrupt, they will pay out the bonds before paying out the values of the stock. And then the third piece is pay out interest as a way to pay back a loan money. Stocks, on the other hand, are ownership of a company, and stocks increase in value as the company increases in value and may be eligible for dividend payments at the end of the quarter for good performance. So with stocks, it's different from bonds because you're not getting paid out every coupon period or every payment period. What the reality is every quarter you see if your company's doing good or bad, and the value of the company either goes up or down. So if you have $10 worth of stock and the company goes up and it's going well, the value of that company goes up to 11. Now, if the company makes $1 million and they pay you based on your percentage of ownership, then the value will go up even more on top of you getting a check, because people want money. They want value. So they will pay a good amount of money, probably even more than it's worth, to own stock that does both. Okay? So now, the road to wealth, Suze Orman says that you should subtract your age from 110, and that should determine the percentage that you should allocate your assets towards investment. So if, for me, for example, I'm 28 going on 29. I subtract that from 110, and I'm going to use a calculator. Should be somewhere around 80. I'm good. Yeah. 110 minus 28. 82. Yeah. So I should be investing 82% of my assets, while the rest of it, which is 18%, should be going towards safe, liquid assets, like a savings account. Okay? Now we're going to be talking about investing in mutual funds, which I find to be the safest, easiest way to get involved with investing early on. Mutual funds are great. They're closed-ended. There's three types of funds. There's closed-ended funds, exchange-traded funds, and open-ended funds. The way you want to think about mutual funds is a basket of goods that are bought, and you could also take advantage of the earnings or the increase in value by buying pieces of it, right? And we're going to talk about how that value is determined, or how much you have to pay to get a portion of that. So a closed-ended fund is a mutual fund whose shares are issued by an investment company only when the fund is organized. After all the initial shares have been sold, an investor can only purchase shares from another investor who wants to sell them. So what this is trying to say is that the investments and what is being bought is managed by an investment company or financial analyst, and they determine what's being bought and sold. So what you're really buying, right, is the performance of those funds. So as far as what those funds are being invested in, you're looking at the strategy. So if you think that strategy will work for you, you just buy the strategy. You don't have to buy the actual stocks and bonds. And in most cases, you probably perform either better or just as well as someone who, let's say, is doing it on their own. And the reason being is because these companies have large amounts of money that they could invest in stocks that potentially you probably wouldn't be able to buy. They have tools and resources that allow them to make better decisions about the stock market. And there's an emotional aspect that's taken out. When you are emotional and you see that you're losing money, you want to pull out right away. These people understand the situations that the economy is in, and in most cases, the long term, the economy usually goes up. It's just a matter of how much you can make during that period that's going up and how much you could buy in the periods that's going down. Okay. Exchange traded funds. A fund that invests in a stock or other securities contained in a specific stock or security index. Now, an index is just it's something that matches the performance of, like I said before, specific stock or securities. So the one that comes to mind for everybody is S&P 500. Now, S&P 500 is the 500 top performing companies in the market. So an index would match those companies and probably buy stocks within those companies in order to get the same return. And often you'll find that the index stock performs better than the average performance of those companies being indexed. Why is that? Because of the previously described things: technology, money, assets, resources that actually contribute to the performance being well. Open-ended fund is a mutual fund whose shares are issued and redeemed by the investment company at request of the investors. Investors are free to buy and sell shares at net asset value. So what this implies, in a lot of retirement funds are open-end funds, because they allow you to move your money out from one mutual fund to another through the net asset value. And we'll go over it in a little bit, how to calculate the net. So classification of mutual funds, it could be a basket of stock funds, which is just a fund that invests in stocks. Types of stock funds is aggressive growth funds, equity income funds, global stock funds, growth funds, index funds, and international funds. And these are not the only ones. You could get technology funds, you could get technology stock funds, you could get oil stock funds or energy stock funds. You can get in whatever you want. It's just a matter of looking at who offers the product and if it's worth the investment. Then you have bond funds, which are a fund invested primarily in bonds and other debt instruments. Type of bond funds include high yield bonds, which are usually referred to as junk bonds, immediate U.S. government bonds, long-term corporate bonds, you name it. If there is a bond out there, there's probably a bond fund that invests it in those funds and gets you a better return for you just buying stocks or bonds. Okay. Other funds include asset allocation funds, balance funds, funds of different mutual funds, and money market funds, or things that are tied to the market. And those are usually lower performing because they're more diversified. But like we said before, if they're more diversified, there's a lower risk of you losing money. Important formulas: the net asset value. So the value of the asset that you're buying is dependent on the value of the fund's portfolio. Portfolio is just another word for basket of stocks and bonds, right? And when I mean basket, I don't mean a literal basket. I mean like a grouping or a collection of these assets, right? So the value of that full collection minus the liabilities, because there is a portion of the money that's borrowed, right, to buy these larger investments and these larger stocks at certain amounts, right, which will give you the value of the fund's portfolio minus the liabilities will give you the actual value of the portfolio. And then you divide it by the number of shares outstanding, which means the number of people that own a piece of it, and that'll give you the net asset value for a piece of that mutual fund. Okay, so let me describe it this way. So if I have this grouping of different stocks, let's say in S&P 500, right? That's a S. Okay, and I want to figure out what is the NAV, what is it cost to get this piece. What I'm really doing is taking the full value, right, which is the value of the fund's portfolio minus what I owe, the liabilities, and then dividing it or taking out this piece here to get the actual value. Okay? Now, the other one formula is total purchase equals investment minus total commission, and total commission equals investment times load. And this is important to figure out how much is actually being purchased. Like if I give a mutual fund maybe $15,000, and they, out of those $15,000, they will deduct commission from that and invest the rest of the money, right? So again, if I put 15,000, look, Jesus Christ, if I put $15,000, by the way, red is my favorite color. That's probably why I'm always using red. If I use $15,000, right, and I invest it, the company still needs to make its money. So they're going to subtract whatever the commission is. Let's say the commission is, well, let's see. The total commission is the investment times the load. Let's say the load is 1.5%. Or we'll make it 1%, just for the sake of the example. Right? So 1% of 15,000, if we calculate it, 0.01 times 15,000 is $150. So the total commission is $150. So guess what? I take this number and subtract it from the $150,000. Then minus 150 gives me, this equals 14,850. Man, that looks bad. Jesus. That is a 5. That is a 5. Yes, 14,850. Okay. Yeah. All right. If you have any questions, feel free to email me. I could definitely go over some problems and maybe give some more examples to you. Okay. Last but not least, have a great winter break. You guys have been awesome, and I'm honored to have you guys in my course. I will be teaching it next year, hopefully from the start of the semester, because I know that was a big problem for everybody. But you guys are excellent. Finish strong. Any questions, feel free to email me. Again, you guys have my number. You could text me, call me. I am a resource for you guys, even after you guys finish my course. All right, man? Take care, be blessed, and have a safe holiday break.